Well, I think we've got a good crowd here, and welcome everyone. Today we're blessed to have our friend and colleague Brittany Green join us. Brittany is a valuation guru. If you haven't heard or seen Brittany yet, strap in. The gal goes from 0 to 60 in about 2 seconds, and she will load us up with great information. And Brittany, as always, it's great to have you back. Thank you for joining us again.
Well, thank you, Doug. I think you literally just summed up my entire personality in about 4 sentences. And my dad is sitting about three feet away from me, absolutely chuckling, because he's my business partner. And so, yeah, that's literally me. So, hi, everybody. I am super excited to be here. I'm going to try to share my screen. I just learned how to do Teams. Yeah. Oh, I'm sorry. Hold on. I did the wrong thing. Hold on.
Wrong window. Yeah.
Presenting. Okay. Wrong window. I had a crash course in this last Wednesday, so forgive me 1 second. Let's see.
No
PowerPoint
problem.
slideshow. Share. Let's try that one. How's that look for everybody?
There we go.
All right. Perfect. So let's see if I can. Whoops. Well, that's not it. Okay. Sorry, guys. Give me 1 second. Jeez.
You'll have to drive from the PowerPoint screen, not the.
Okay, but you guys can still see that, okay?
Yeah.
All right, perfect. Okay, cool. So today we are going to be talking about add backs, inventory, other assets, and valuation. So this is to be a little bit of a crash course, or as Doug put it, a 60-mile-an-hour overview of the add backs. A little bit about me, because I do see a lot of new faces. My name is Brittany Green. I am a certified valuation analyst and owner at Green Appraisal. So we handle valuations for all kinds of purposes, from acquisition, due diligence, business divorce, marital divorce, gift and estate tax planning, all kinds of fun stuff. In addition to, I am a certified financial data analyst, as well as my degree is actually in business analysis, so top-down analysis. I'm an instructor for the Texas Association of Business Brokers. I teach a 4-hour class on business valuation. So if you really get a hankering to learn more, come spend 4 hours with me. And in my free time, I actually founded and the president of a nonprofit organization called Clear Lake Ladies Night Out. And the only reason we exist is to shine a light on other nonprofits in our community and to help raise funds for those organizations. So what is on tap for today? It is not 5 o'clock yet here in Houston, so we'll, instead of drinks, we'll go for information instead. So we're going to talk about what are add backs. We're going to look at the role of inventory in a business valuation. How do we evaluate other assets, and then adjustments and how that impacts the valuation. So add backs. Now, Doug and I originally met earlier this year after the last speech that I gave on add backs and seller's discretionary earnings. And in that presentation, we learned that add backs are seller's discretionary earnings, but not all seller's discretionary earnings are add backs. So it's kind of like jacuzzis are hot tubs, but not all hot tubs are jacuzzis, right? So we're going to dig a little bit deeper into add back specifically. So an add back is an expense that is not included in the buyer's P&Ls for the company. Now, some people ask, well, why does this even matter? It matters because it helps us to normalize earnings and just provide a clearer picture of the value of the business. So what are some common add backs? Because add backs are almost they're not set in stone, right? Everybody's going to have a different opinion as to what can be added back and what can't. The bank is going to have one opinion, a valuation analyst is going to have another opinion, and the seller is definitely going to have a different opinion. So some common ones that you may run into through your adventures in doing a business purchase would be some non-reoccurring expenses. So some examples of that would be a lawsuit settlement, a one-time equipment purchase. Even if the seller was using some professionals to help them be able to do an exit on the business, those are one-time non-reoccurring expenses. While they may have a monthly expense for 1 year, it's not a 5-year term, right? So that could actually be a add back. Owner specific expenses. So this would include anything that lands more on the personal side. Their travel, car lease, if they could give themselves an excessive salary. So most owners that you're going to come across will say their entire salary should be added back into the evaluation. And unfortunately, we have to tell them, sorry, that's not how it works, because you as the buyer, you're not buying the business to not make a salary, right? You're in it to make money. So you may not take as much of a salary as they do, but we still have to include a salary as it is. So in valuation, what we do is we'll take, if they're taking a $200,000 salary, industry information tells us that for their state and their position, $120,000 is what standard. That would get adjusted down about $80,000. So it would be a partial add back. Non-cash expenses like depreciation or amortization. And finally, unnecessary or redundant expenses. So an example would be unused subscriptions. And talk to just about any seller and they're going to tell you every expense that they have on their P&L is an unnecessary expense, just because they want to add everything back and boost evaluation. So that's why we must treat add backs with a certain level of scrutiny. So what do we keep in mind? Is the add back actually documented? Can they prove it? On top of that, can they provide the documentation associated with that add back? So for example, let's talk about the salaries. All right, so if they're trying to add back their entire salary, what documentation do they have that their entire salary should be added back? If they can't explain to you why the entire salary should be added back, is it finally justifiable? Okay, so you kind of follow this process, and it's 3 steps, so it's not a whole lot, but you would follow this process as you assess each potential add back that you're encountering, right? And trust me, I have received just laundry lists of add backs that sellers have told buyers that they would do so that they could adjust, so that when they do their valuation, they'll arrive closer to their number. And when I look at it, I'm like, that's cute, but no. So this is just kind of that 3-step thing to kind of keep in the back of your mind. I'm also going to take this opportunity to say that I will send Doug the PDF version of this presentation when we finish up today. So if anybody would like it, Doug, you can do the distribution, or if you'd like to reach out to me directly, I can get that to you as well. I'll make sure you guys have my contact information. So,
hey, Brittany, can I jump in there on your step 2 there on the documentation to support the claim? Talk a little bit more about what's normal and customary for good documentation.
Really, it is. So, all right, what we could say, let's talk about rent, could be another example. So if they are able to provide a lease, okay, and their lease is saying that they have just renewed and they renewed for a more advantageous lease, so they're going to add back in $2,500 a month into the rent, and that's what should be added back. Documentation would be the new lease agreement that was signed. Same thing with the salary documentation. If they are able to go and source that, to be able to justify, there's multiple online sources to be able to source salaried information. We go to a couple of different areas to search that. But if they can provide documentation saying that, their C-suite executive position is supposed to be making $250,000 a year, and that's how much they're taking, cool. That would be an acceptable piece of documentation. So to answer your question, Doug, it's a little bit on a case-by-case basis of what is the particular add back they're trying to do. But the top 2 that we get consistently is rent and salary is what they try to add back in. Additional documentation, funny enough, I just had a consultation with one just before the holiday where they were adding back in a bunch of construction expenses because they had to do reconstruction on their home. They were remodeling their house. And they ran all of those expenses that they were paying the contractors through the business. So they actually provided receipts and information from the contractor to show how much they had actually paid to those contractors to justify adding all of those expenses back in. So we also had to then prove or look at it from that perspective of, okay, is that home, which was what was being reconstructed, is that being used for office purposes to where the company would actually pay for some of it? So it came down to, fortunately for the buyer in that case, they did not operate the business out of their home. They just literally were running their construction through their company and letting the company pay for it. So they provided all of the construction receipts. So does that help answer?
Yeah, and
Awesome.
not to get too deep in this hole, but makes me wonder what their tax returns for that year are going to show and what that's going to look like versus the business performance.
Yeah, I really want to get my hands on that valuation. I actually have a follow-up call with him tomorrow to see he was doing a site visit with the owner last Tuesday. So I'm really curious to see if I get my paws on that one, because I'm super interested to see how all the documentation goes. So yeah. I geek out about the weirdest things. So
for the benefit of some of the newer folks on our call here, I bring up the tax return because we've had experience in the past year where a owner was, let's say, doing some funny things with their business versus what they were telling the IRS, and your SBA bankers are going to reconcile all of that, because SBA is a government agency, IRS is a government agency. They sort of scratch each other's back. And if the tax returns are too far off of what they're trying to tell you in the financials on the business, it's going to be a no-go on your SBA financing.
Because the bankers, to add to that, Doug, the bankers are actually going to look at the add backs on the tax returns first. That's actually where they're kind of opening salvo for justifying add backs is in those tax returns. Yeah. So they don't typically believe the owner when they tell them, when they look at financial statements, to say this is an add back and that's an add back and this is an add back. They're actually going to default to the tax returns first. So
exactly. Yep.
So all right, we are going to see how much you guys have been paying attention. So we have a little pop quiz on, is it an add back? So yes, I'm testing you to see if you've been listening to me for the last 16 minutes. So first up, owner's compensation. Is it an add back or not? Anybody can come off mute to answer.
Sometimes.
Sometimes. Okay. Gold star. Who just got a gold star? I'm sorry, I can't see the screen.
Oh, Sheldon.
I think that was Sheldon, and Puneet said the same thing in the comments.
Oh, I'm so proud. All right, good job, guys. All right, tickets to getting the hottest thing on, well, I don't even know if it's still on Broadway, but it was at one time, and I picked it because the movie, no, I haven't seen it. But if they were to purchase tickets to go see the show on Broadway, is it an add back or is it not an add back? Don't be shy.
No way.
Puneet said not part of the P&L. So
if they are listing it as an expense, this could be considered a personal expense to the owner. So there is an outside chance that it could be considered an add back. It depends on who the tickets were for. If it was for an entertainment for a client, it would not be considered an add back. If it was for the family, then it would be, because it would be considered a personal expense. So it's a sometimes. All right, rent for the building that the owner owns through a different corporation. Is the rent that they're paying themselves an add back?
No.
Okay. This is another, it depends. I had a case where a owner was paying himself $1,600 a month in rent because he owned the building. The standard rent for the area was at the top end for that size building and purpose was only $3,000 a month. So we actually adjusted the rent down to what was ordinary. So much like owner's compensation, if rent is extraordinary because that's how they're generating an additional revenue for themselves, and it's over and above, we could actually do an adjustment down and technically do a partial add back for the rent of the building. And finally, professional fees associated with planning the owner's exit out of the business. Yes or no?
One time, yes.
Yeah, those are one time.
It is a one-time expense, so yes, it would be an add back. Good job. I'm so proud of you guys. Yay. All right, so let's leave the land of add backs and enter into the world of inventory. So taking a quick sip here, inventory is a working asset. It could be raw materials if you are in the home services based arena of construction, finished goods like my cup here, or it could just be supplies of some sort. Like if we're talking about an HVAC company, it could be the thermostat or the ducting or whatever. It's ducting, there's a T in there, something like that. Okay, all of those things could be considered inventory. You would even consider inventory of being perishable items for foods or for restaurants. So the where it falls apart in valuation, or where people get confused about inventory and valuation, is that of how it is treated. It is excluded typically from the EBITDA, but it is included as part of the total purchase price. Now you're probably sitting there saying, Brittany, why are you excluding it from EBITDA? But I'm ending up paying for it. So think about where inventory is stored when we're looking at financial statements. Okay, your EBITDA is on your P&L. So you've got revenue, cost of goods sold, expenses, your earnings before interest, taxes, depreciation, amortization, any other expenses, and things like that. You have net income. So EBITDA is on that side. Your inventory is stored as an asset on the balance sheet. So EBITDA does not cross over into the balance sheet because we're looking at assets equaling the liabilities plus the equity. So the inventory is hanging out over here on the balance sheet, and the EBITDA is hanging out over here on the P&L. So inventory is typically excluded. So if you're looking at an income-based approach to valuation, which we do quite often, and I like it because it's cash flow, is that your valuation would be that cash flow valuation plus whatever you can negotiate for the inventory. It's almost treated like an additional, like if you were to buy the business in the building, right? The billing of it is just going to be a tack on to the total cost. So some key considerations whenever we're looking at inventory. We're looking at the valuation methods. So is it first in, first out? So if it's coming in first, it's the first thing that's going to come off the shelf. Is it last in, first out? Or is it a weighted average of both? So typically, if you're talking about a perishable item, something like that, last in, first out is where you're typically going to go. If you're talking about a non-perishable item, quite honestly, the differentiation between making the decision of a first in, first out versus last in, first out is really almost detours or defaults to your inventory days and how much does the inventory actually move through. Now, another key condition is going to be the actual condition of the inventory. Is it obsolete? Is it slow moving? How long has it been sitting there? I'll share a short story with you guys. When I first started my career as a business coach way back when, I had a gentleman that sold safety equipment, gloves, fire extinguishers, stuff like that. And so we did an entire assessment of his entire inventory. Like we are talking over 500 independent inventory numbers, SKU numbers, okay, 500 of them. That's a lot in case you're wondering. So what we were able to determine of these 500 numbers, only 20% of his inventory had actually been sold in the last 18 months. So 80% of his inventory had been sitting there for 18 months or more. So in that particular instance, we're talking about obsolete and we're talking slow moving, both of those two things. So if you're looking at purchasing a business, okay, and the inventory is slow moving, but how do you determine if it's slow moving? There's a calculation that we do in due diligence that is called an inventory days. So basically what we do is we assess, or we're able to calculate roughly how long is the inventory sitting on the shelf versus the industry. So we're able to at least get a gauge to find out how slow or quickly the inventory is moving off the shelf, because at the end of the day, it's the equivalent of cash sitting on the shelf, just collecting dust, right? They've already spent that money, but they haven't gotten that money back. So finally, there are seasonality. So you want to ensure the timing of inventory levels aligns with the financials, right? So we all know in home services-based businesses, especially depending on what part of the country that you're in, as we were talking about Buffalo having snow, they're probably not calling their air conditioning man right now, right? Because they just have to open the door if it's hot inside. They can get plenty of cool offs that way. So the inventory levels in the winter time for an HVAC company are going to be significantly lower than during the summer months. Now, here in Texas, on the south side near the Gulf where I live, HVAC companies are busy year round. Now, in the winter months, we are a little bit slower. It was 67 degrees whenever last time I checked the temperature, so about an hour ago. But in January and February is when we actually have our quote unquote winter, right? So again, their inventory levels are going to be a little bit lower. So just because you go in and you see that they have low inventory or high inventory, keep in the back of your mind or ask those questions of, is this lining up with their busy or slow season part of the year, right? Unless it's a year-round business, and then there's no excuse. So.
Hey, Brittany, let me throw in something else on that condition of inventory. We had a company earlier this year that it was an electrical company and predominantly commercial. And when the buyer went to talk to the seller, they were walking the property, and there was a work shed, yard, barn type thing. They opened the door, and there was this mountain of inventory back there, little connectors, boxes, fuses, wiring, a whole array of mishmash, probably something on the order about 400 square feet of space that all this was stacked floor to ceiling in various bins and boxes and things. Totally unidentified in terms of detail inventory, no exact tracking of original cost or anything like that. They did a literal swag, and the buyer said, I'll offer you 10 grand for the whole mess. And the seller said, fair enough for me. So back to your original point, inventory's over on the balance sheet, EBITDA's in the P&L. My point is, sometimes you're going to run into these opportunities where there's a collection of inventory, spare parts, and raw materials. You might not get a detailed accounting of what that originally costs, and the seller may not have a good valuation in mind, and you're just going to have to negotiate something.
Doug, it's like you saw my presentation before I started it, but you just led me into the red flags when it comes to inventory. All right. I swear, guys, we did not tee this up. He has not seen this. He's just expecting it. Okay. All right. So the red flags to look for in inventory is exactly true. It's excess inventory. It could be a signal of poor demand, like with our guy. Like, he sold a ton of gloves, but he hardly sold any overalls. And this guy had more overalls in the South than in the summertime. Okay. It just doesn't happen. He had a lot of them. All right. So, but the other thing is, it could be a mismanagement. Sometimes owners, especially if they're the salesperson, have a perception that, everybody wants this particular item because they like it. I may think that everybody wants a pink cup because pink is my power color. But if I have 200 pink cups sitting on the shelf and there are no red cups, then my perception or my mismanagement of the inventory is that I'm playing favorites to pink, as opposed to I should be putting those dollars into red cups, right? All right, so not sure when the last inventory count was. That's exactly what Doug just said. These guys may not, or ladies, I'm not going to discriminate, may not be tracking their inventory on a regular basis. Now, what does regular basis mean? I actually went to my dad, who is the inventory guru for us, because he's had a lot more experience with it than I have. And this is just kind of a general rule of thumb, right? If you have perishable items, you're looking at a restaurant or something like that, perishable items are probably going to be inventoried on a weekly basis, okay? Auto parts or something similar, like our safety supply company, do a once a month random check. Like, pick 15 or 20 different of your SKU numbers and check those numbers. If those numbers match what's in the computer, you can have a reasonable expectation that more of your inventory is correct. Believe it or not, my extra job in college, when I wasn't taking classes or working for the university, was doing audits for Radio Shack, and this is exactly what we did. They had a locked locker of expensive electronic items. And so we had to count all of those versus what was in their computer. And the company gave us a list of 15 other items to go check the inventory count on. So this is something that even before the dawn of Amazon that killed Radio Shack, even they did it. But you also would want to do an annual inventory count as well. So you would want to find out when was that last inventory count and try and request those reports as well. Finally, for something in home services like an HVAC, because there's going to be a high amount of turnover, plus there's not a whole lot of inventory, just mainly what they're keeping on the trucks, it would mainly be an annual check of that inventory. And finally, looking at the discrepancies between the records and the physical count. Okay, you need to kind of decide for yourself how many of those discrepancies is okay. And if there are a lot of them, are you willing to do like what Doug just said with one group is, okay, you know what, there's a lot of discrepancy here. Instead of going back and forth, I'll just offer you 10K for the whole bit and we'll just move on with our lives. Okay. So sometimes you are able to walk into a deal like that, and sometimes people just don't want to store it anymore, and they'll give you whatever it is that you want for it. So, some red flags to keep in mind about inventory. Now, finally, assets. Well, specifically other assets. So assets can be considered tangible, like equipment, vehicles, real estate. Intangible items, which kind of the bane of most people's existences, could be trademarks, patents, customer lists, or even my favorite, goodwill. Contracts and agreements, leases, supplier agreements, employee contracts. I've actually worked with one of the folks from this organization or from this buyer program that was actually looking at buying a company purely to get the contract that they had. So, that actually, those are kinds of things that will make a company attractive. But how do we value those? So when we're looking at assessing those assets, you basically need to bring in an outside professional, especially for significant tangible assets like buildings, large equipment, or even pieces of land. I just had an evaluation. It was for a divorce case where I was actually valuing a cow farm. So I actually valued the value of the business of actually the buying and selling of the cows. And the attorney called me and said, hey, is your valuation including the appraisal of the land? And I said, no, because the farm is in Arkansas. I am on the south side of Houston, so no, it's not going to include that. So they actually went and got an appraisal of the actual farm so they could include that in the total price of the asset. So that kind of thing happens often. So be prepared that I don't know how many of you are going to go purchase cow farms, but if you need to, you will want to get a value of the business plus a value of the farm itself, and maybe make a friend or two while you're out there. Additionally, you want to evaluate intangible assets. So exclusive contracts, what are those worth? Online courses. I just had a valuation presentation last week right before the holiday, and I saw something in their revenues. So they were a government contractor that did cloud-based services. So government line, and then they had a commercial line. So my question to the owner, because he was getting ready to sell this business, I said, so what is the commercial? Do you have contracts with commercial businesses? And he said, no, that's actually an online course that we sell through Coursera or, a couple other places that he listed. And it was making up about $4,000 a year worth of revenue. Now, it doesn't sound like a whole lot, but it's still a revenue stream for the potential buyer, right? So I asked him, I said, well, have you had the online course assessed as to how much that course is actually worth to you? He said, what are you talking about? I said, because it's actually an intangible asset of your business. So this is more on the, for him on the seller side, but if that's something that is included, you would want to find out how did they assess the value of that online course. Was it by the person who actually developed that course for them? Was it an outside entity? Did they actually get a professional to come and say, hey, online courses typically go for X, Y, Z? How do they document that? Again, documentation. And finally, goodwill. Now, goodwill is a bit of an arbitrary number. I've seen people pull goodwill out of what seems like nowhere for how they assess it. Now, I also have actually done goodwill calculations. There's multiple ways to go about assessing how much goodwill is worth, because goodwill is not only it could be professional so it's the person, or it could be business goodwill, so it is associated with the business. So there's actually a couple different calculations that go along with that. The key to those is understanding what is acceptable in your state. Okay, so I had a case earlier over the summer that was in Florida, and the type of goodwill calculation that we used was not accepted by the state of Florida. So we actually had to go through and actually purchase other software to be able to calculate a different goodwill calculation that state would actually accept. So if you are in one of those states, or goodwill is something you're going to want to calculate, talk to like an attorney or someone that's helping you with this, and find out if there is a specific formula that is required by your state for goodwill specifically. Because if they just say, oh, I'm putting 300,000 because that's how much I paid for it, and I wanted to make sure that's how much I got out of it, that's not how goodwill works. And I say that because I actually heard a seller tell me that one time when I was doing due diligence for a buyer. I said, so how did you arrive at this number? She's like, well, that's what I paid for it. I'm like, okay. She's like, well, I figured if I listed it as the goodwill, I would make sure that I got that plus whatever the business is worth. I'm like, yeah, that's not how it works. So understanding what that is, and always, I know you guys some of you are new to my presentations, but if you, the seller tells you something of, hey, this is how much it's worth, ask them how they arrived at that number, whether it be the value or just about anything. Always ask them, how'd you get there? Because you get some interesting answers. So what are some checklist items for this fabulous group of individuals? You want to ask for a detailed asset list with their current values, okay? Secondly, you want to find out if there are any encumbrances on those assets. An encumbrance could be a lien, a lease. Did they use one of those assets to secure a line of credit, and so it actually is being used as collateral for money that they borrowed? Okay, so if you are assessing those assets, or it's going to be part of your purchase, you specifically want to ask those questions, because if you don't, they might not actually disclose that as part of the information that they give you. Okay, so make sure you ask those questions. So next up, we are right on time to leave plenty of time for questions. So what are some tips on some adjustments? So whenever we're making adjustments, we want to ensure that the add backs and the assets accurately reflected in the offer, right? So most of the time, I am brought in between the letter of intent being signed and you guys getting access to all the financial documentation and the actual offer being submitted, right? Because while the sellers have great intentions on how much they're asking for the business, we want to be able to back it up with proof and have an independent opinion. Nice to meet you. I'm your independent opinion. Okay. So you want to make sure that any of the add backs or assets that we're taking into consideration are appropriately documented, right? Now, the add backs can swing the valuation up, or it can swing the valuation down. So one of those things is, once you've actually you've gone through the process and we've assessed what those add backs are, then we need to have that conversation with your buyer team. Because again, the seller may give you a list of add backs, and that may be included in their prospectus, because that's most of the time where I see them, as they're saying they're going to add back this, add back that, add back this, but hey, this person's willing to stay on, but at this salary. Okay, if you have that situation, because I've seen it happen, is that they're taking like a $90,000 salary right now, but they want to stay on but get a $200,000 salary by staying on by your employee, that you're adding back 90,000 to remove 200,000, and because you're laying out additional dollars for another employee, that is going to bring your valuation down in an income-based approach. Okay, so that's something else to remember. Add backs are typically going to affect your value more in an income-based approach versus a market approach or an asset approach, but it's still going to affect it in the other ones as well, because again, you're using the base financials at the end of the day. Okay, so it's not necessarily an add back at an adjustment to the inventory. So you've made your inspection of the inventory. You may have gotten an outside opinion of the inventory and received that assessment as to how much it's actually worth, because you brought in an outside consultant. the inventory may be adjusted in the valuation to reflect your new value of the inventory. Okay, so if they've listed the inventory at $100,000, your expert says, well, I actually can only really assess the value of it at $80,000. Then in the valuation, we could actually go in and adjust that inventory to reflect 80 than 100. Okay, so that's where you would run into some additional adjustments or some additional changes in your value swing, right? So I kind of hopped down. I'm going to come back up. So how many add backs are too many? Quite honestly, that's up to you to answer. The case that I told you about where they literally did the reconstruction of their house and they let the company pay for it, that was just kind of the tip of the iceberg. This company literally ran every personal expense that they had, including their Netflix, their Disney Plus, their Discovery Plus, all basically anything that they did as a family, the company paid for it. So they have adequately documented all of it and provided them a pretty detailed spreadsheet of all of their personal expenses, including the construction. The construction's a whole nother tab of what they run through the business. So it's going to be a really interesting time to do all those adjustments. But again, is that something that you're willing to take on? Okay. How do you make that decision? It's truly and 100% up to you in that. Do you want to take that risk on that business? Okay. So you also, forgive me, my dogs are barking. You want to verify financial documentation and valuation with an independent advisor. So also independent advisor, look at a CPA. You don't want to rely solely on seller provided figures. Verify through other sources. So like I mentioned to you guys that if the owner tells you, hey, or they provide you an Excel spreadsheet that says that, because this actually happened with a, hold on one second, guys, I apologize. Dakota, hush. Benefits of working from home, you get to have your dogs with you, but when you're in a presentation, they bark. So we had a mobile concrete company out of Pennsylvania that their accountant, their in-house accountant provided me Excel spreadsheets to be their financial statements, right? So our independent verification was their tax returns. So if you have one source, you always want to get a second source. So whether that is the tax return, it's banking statements, it's whatever it is that you can get to be that independent verification of their information. So much like Doug was talking about earlier with the SBA and the banks, and that they're going to take a look at, you know, the tax records, and then they'll look at the financial statements, because you just want secondary verification. Okay. So what are our key takeaways from today? So add backs provide a clearer picture of the cash flow, but they do require scrutiny. So we do want to take a look at each and every one. That just because the owner says so doesn't necessarily mean it's true. Hey, we need to add back all of my salary, but we may not necessarily need to. Inventory and asset evaluation are integral to an accurate valuation. If the inventory is off the charts, if they haven't done an inventory assessment of their company or their inventory in 2 years, but they're still listing the same inventory amount, the value of it can be skewed, right? And then strong due diligence is just your best tool, okay, in a negotiation. If you've gone through, you brought in all of your experts, you have taken a look at this company 6 ways to Sunday as far as doing your due diligence to understand where you are, then you are in the catbird seat from negotiation, right? And that's one of the roles of this group. They help you with that process. So I'm 100%. You don't know how often I brag on this group of buyers right here. I brag on you guys all the time because you guys are always out for the most information, to get it right, to do everything. And I brag on y'all all the time. You have no idea. So because at the end of the day, you're spending time and you're investing time in your future purchase of your business. Now, finally, here's my contact information, my office number, my cell phone number, my email address. Doug has this as well. So if you guys have any questions on anything, please feel free to reach out to me. I am here to answer questions on quite literally anything. You just have a business that you're taking a look at, or you run into something weird, you just want to ask somebody a question, I'm here. So we're at 16 minutes to go. So you guys can rapid fire your questions.
We got 2 questions in the chat.
Okay.
Puneet, you just want to go live and answer or ask your question?
Sorry, I
can
couldn't see it because of the PowerPoint. My apologies.
No
can
worries.
you hear me, by the way?
Yes.
Yeah, we
Absolutely.
can hear you.
Nice to meet everyone. I'm Puneet Pandit. My first question is effectively, what free online resources are there for me to ascertain various industry benchmarks, be it what's the optimal liquidity ratio in test center prep or an HVAC, things like that,
Right.
number one. And I'll leave it that question, then I'll answer the second. I'll ask the second one after.
Okay. All right. So as far as free online resources, if you're looking for free, there's some that are available through like a local library that are available. I will warn you on those that sometimes the information isn't exactly recent. It could be 2 or 5 or 10 years old. So if you're trying to access that kind of information without a fee, you've got to understand that you're not going to have the most up-to-date information. Through our company, we do offer industry benchmark information at a reasonable cost. So if that's something you'd want to have an offline discussion about, 100% be willing to have that conversation with you. Because the industry information we access is updated literally every day. So we're able to do like a rolling 12 months, just, 2023, so on and so forth. Since we're into December of this year, we have a good feel for what 2024 looks like across the industry, all industries that we have access to. So, but as far as free resources, the only ones I know of are available like through like your local library.
Okay, thank you.
Absolutely.
And I had 2 questions after that, just so
Okay.
I understand the nomenclature. So
Sure.
when you're saying an income-based approach, I'm trying to understand that relative to GAAP. Is that a cash flow, basically looking at the cash flow statement? And it's when you talked about multiples, like is that effectively multiples of EBITDA or an asset valuation? So me just understanding the nomenclature of what you're using. And second, are we not using a typical DCF, like from a GAAP standpoint, to triangulate in on a valuation? So looking at multiples, doing a DCF, and then precedent transactions to say, all right, here's what I would do. So 2 questions there. Just so I'm new to the group, so.
Theoretically, I should be able to answer both in one go. So I'm going to try and condense it all into one answer. I'm going to do my best, okay? So understanding valuation. So there's 3 buckets to valuation, okay? So you have an income-based approach, a market-based approach, and an asset-based approach, okay? So 3 methods of valuation. Under each method are various calculations of value. So when we're talking income, we're looking at either a capitalization of benefits or a discounted cash flow valuation. Now, capitalization of benefits is looking at a historical performance of the business to assess value. Discounted cash flow is looking at the future potential of the business to assess the value. So incorporated under that, you're going to be looking at either a capitalization rate for capitalization of benefits or a discount rate for a discounted cash flow. Now, the difference between a capitalization rate and discount rate is growth, okay? Right now, it's averaging about 3%, 3 to 4%, really just kind of depend on your evaluator. Right now, we're using 3, okay? So that's your discounted cash flow. Now, under the income-based approach, we are evaluating profit and loss statements and balance sheets, okay? That's what's going into those. We're not really assessing cash flow statements to assess an income value of the business, okay? Now, looking at the market-based approach. Market-based approach is where your EBITDA and your multiples are going to come into play. Easiest way to explain a market approach is like whenever you bought your home, okay? So the realtor or the appraiser went and got, or the realtor got well, actually it would be the mortgage lender, went and got a appraiser to come in and look at your house. It's a 3-bedroom, 2-bathroom, upgraded kitchen, right? It's going to look at the neighborhood and find other 3-bedroom, 2-bathrooms with upgraded kitchens in your neighborhood to find out what did those sell for to assess the value of your business. This just happened with my house, right? So back in April, we had that done. A house around the corner sold for, so our house should have been around $420,000 because a house around the corner sold for $380,000. That's what my house ended up appraising at, was $380,000. So because that had sat on the market for 18 months, we lost out on value, okay? That's just the nature of real estate. Now, when we're talking about it in business, what we're looking at is different components. So revenue, location, industry. So we're looking at an NAICS SO code or an SIC code, okay? To try and find comparables to the subject company, okay? So we're trying to find companies that are in similar size, if it's available area, and industry to compare yours to. So we're trying to compare McDonald's to McDonald's, not McDonald's to, you know, 5-star restaurant, right? So we're trying to find comparables. In that, under a market-based approach, there are different multiple bases. So you can base your multiple based on revenue, seller's discretionary earnings, or EBITDA. Okay, those are kind of your top 3 for a market-based approach. Now, under those comparables, though, we're then looking at what are those multiples, okay? Because your multiple has to match up with your revenue stream. That is rule 1 in valuation. I don't care what broker tells you it's not, they're wrong, okay? Rule 1 in valuation under market approach is your multiple has to match up with your revenue stream. If you don't, you're in trouble, all right? Because if you take an EBITDA-based multiple and multiply that times your revenue, it's not going to match up. You have to match up your EBITDA multiple with your EBITDA valuation or SDE or whatever, okay? So how is that determined? It's decided by us based on the situation of the business and what we understand its operations, you know, how it sits. There's a bunch of different components that go into that, okay? And then you have, finally, you have your asset-based approach. Now, your asset-based approach is basically assets of the business minus the liabilities, add in any, you know, that's essentially how we're assessing the asset of the business. Now, as an evaluator, when do we pick those? So I just described about 4 different ways to go about valuing the business. Which one of those is correct? Technically, all of them are. All 4 calculations are correct. What we have to decide is based on the company, the purpose, the time, the situation, which one is the most accurate for this business at this point in time, okay? If I'm assessing a business for sale and then I turn around and assess that same business for a probate case, they're going to be different, okay? Because if it's for sale, I could use a discounted cash flow and look at the future potential, and the value of the business could be $5 million. But if I'm looking at that business from a probate perspective, because the owner has passed away, there's an end date. I can't look at the future of the business anymore. I can only look at it to a certain point. So that's going to put me into a market or an asset-based approach. So a long drawn out answer to hopefully answer your question, but associating an income-based versus like a GAAP, you know, GAAP is generally accepted accounting principles, right? So it kind of becomes the basis of it, as opposed to like, your GAAP is going to be assessed to the financial statements. The GAAP doesn't necessarily cross over into valuation. Okay, it's just we're assessing those financial statements. Does that make sense?
Thank you.
Okay.
I'll say it just, I'll add to that. I don't want to confuse this. I hope it balances out. Much of what we do in our recommended approach with quality of earnings analysis on helping you in the due diligence step, once you've already submitted an LOI, there is a test whether or not standard GAAP process was applied and the financials stand up to that test, because that sets your baseline, your foundation. If the bookkeeping was done poorly, things were misclassified, put in the wrong bucket, put in the wrong place, or more importantly, inconsistently applied month over month, you don't have a really solid basis to do any of those methods that Brittany's talking about. So part of our QOE verifies and ratifies that the core financial data you're looking at was good, and whatever assumptions you had to make or whatever method you applied to get to your purchase price stands that sniff test.
Yeah, any of the adjustments that we talked about during the presentation itself, all of that is done before we actually assess value to the business. So if we're making adjustments to payroll, we're making adjustments to rent, we're making adjustments because they ran all their construction costs through the business, all of that is getting removed before we ever start assessing value. Because the fact of the matter is that it just muddies the waters in a valuation perspective. Okay, it's just it just gets all sorts of ugly. So so any of those things are being done ahead of time before we're ever taking a look at what type of we're starting our first calculation or our first assessment.
Yep.
Hassan,
Go ahead. You got a question, sir. You're on
I
mute.
can't hear you, sweetheart. You're muted.
Okay, thank you.
There we go.
Thank you, Brittany. Very valuable information. Really appreciate it. Few questions. Number one, can you elaborate on equipment valuation, when that comes into play and how you would value that? That's my one of the questions.
Sure. So if you're basically what you're going to do is you're going to bring in an outside consultant to assess the inventory. Okay. And the time that's going to happen is when, if you've done that assessment, right? You've taken a look at it. You've asked the owner, when was the last time you did your inventory? It's been 2 or 3 years. I don't remember, whatever excuse it is that they have. You kind of have two options. You could go in and assess it yourself and, get the inventory reports and go in and do your own inventory account. It's going to take a lot of time. Or you can hire an outside consultant to come in and actually do that assessment of that inventory for you. It'd be basically a full inventory account, and they're assessing a value of it from there. The thing that comes into play whenever you're talking inventory is what was the cost of that item when they purchased it. So Bill and I were actually having this conversation before this meeting even started, was that I could buy this pink cup last week, right? And it costs $10. I could buy this cup this week, and because there's a higher demand because it was Black Friday and Cyber Monday, this cup is now going to cost $15 because a higher demand for it, right? But next week, the cost of this cup could come back down, to $10, right? So the cost of what they spent on that inventory sometimes can come into play. So if you have a question about the inventory, then my recommendation is to bring in an outside consultant to come in and do that assessment for you, and then bring it to the table. So if I'm assessing the value of the business and we have that inventory assessment, we're either going to do one of two things. If it's close to what we had in the balance sheets, we're not going to make an adjustment. We're going to roll with it the way that it was. If it's not, we could make an adjustment to it, but in all reality, is that if we are doing under an income-based approach, a capitalization or a discounted cash flow, we're most likely just going to take the value that we determined plus the cost of the inventory. But a lot of the time, sometimes, as Doug had mentioned before, it becomes a negotiation piece. Like if they're wanting to unload it because they know there's an issue, they have accounted it, they don't, you or they don't want to pay for that consultant to come in, you can make a package deal and just get a sweet auction on the entire thing. So I wish there was a universal answer for you, sir, but unfortunately it is kind of a case by case because it also depends on how dependent is the company on that inventory. We had a t-shirt in promotional products company that we valued once, heavily dependent upon their inventory. So the bank had actually called in an outside consultant to do the assessment of that inventory. But in a typical home services, like a plumbing or electrical contractor, something like that, the amount of inventory they're going to have is really negligible in comparison, because they're most of the time they're buying it and using it as they go. So it's really just like if they bought a whole roll of wire, because we just had reconstruction done on our house, they had this huge roll of insulation that they bought, right? And they only used about maybe 10 feet of it. And I've got another 15 feet sitting in a roll in my upstairs. I'm like, that does not need to live here, right? I paid for it, but I don't want it. So now that lives on their truck as additional inventory. Okay. But how do you assess, 50, if it's a 20-foot roll and there's 15 feet left, it's something like that. So it's dependent upon the industry as well.
Sure. Okay. Thank you. Two more questions. One is on the company valuation. Do you adjust for if there's a huge customer concentration? Do you adjust the multiples accordingly? And then I'll just throw the second question, which is how long are your valuations? How long does it take for you to do a valuation?
Sure. So customer retention doesn't necessarily.
Customer concentration, like let's say they get a large source of their revenue comes from certain customers. So do you just look at the net income and do the multiple, or do you adjust the multiple because it's of risks and risks within the business? Do you go that deep?
Yes, yeah, absolutely. Because as part of our valuation, especially on a full detail certified valuation, if we're just doing due diligence and we're just trying to kind of figure out like the ins and outs and get like a basic feel for it, we're not necessarily going to go that deep, right? Because we're just trying to get the initial assessment. But if we're going like full detail certified valuation, we're going like deep dive. We want to know the nitty gritty, where are the skeletons, all that fun stuff, which is my favorite. Is then what we're going to do is we're going to do a background interview with the seller, okay? And we're going to ask those questions. There's literally a 15-question questionnaire that I ask every seller in evaluation perspective, especially in like in this type of situation where it's you're buying the business from them. I'm going to have that conversation with them to understand everything about their business. Where does their business come from? What is their methods? How do they take themselves to market? What is their marketing approach actually like? All of those fantastical things. So, because ultimately my decision as to which value I choose or which multiple I use could come from information that they've provided. Case in point, a dermatologist last month that was out of Montana. She is one of 14 dermatologists in a town of 60,000 people. That's a lot of dermatologists in one town, right? No skin is that bad in Montana, right? Okay, it's like get some Lucerne, whatever it is. Okay, but so she has an oversaturation in her market, in her industry. But it also additional component is that she actually reduced the amount of days that she's in office due to some medical issues. So those two components are actually going to be contributing factors to which valuation method do I choose. Is by having a bunch of the same doctor in the same town and her reducing her office hours, is that conducive to future growth? Not exactly. If anything, it's going to stale out or could possibly decline. So I'm not going to go for a discounted cash flow valuation in that perspective. Actually, in that case, I ended up defaulting to the market approach just based on the situations in around the business. So
and we do much the same thing as on in our intrinsic value calculator. We have a similar list of questions, and customer concentration is one of the categories that'll either adjust your multiple up or drop it down. Because if the concentration is high, we reduce the multiple accordingly. But if it's fairly widely distributed, if you've got 30 approximately equal customers versus 3 major customers, we're going to value that at a higher, more favorable number.
Thanks,
right.
Brad.
So, and just I know we're kind of a little bit over time. If anybody needed to jump and still had questions, I just dropped all my contact information in the chat. So if anybody needed it, didn't get in the presentation, it's there.
Yep.
But Hassan, your other question was regarding, you asked how long does evaluation take? Okay. So it typically can take anywhere between 7 to 10 business days once I have all of the documentation that I need. So basically financial statements, tax records, my engagement letter has been signed, I've been paid, all that fun stuff. I'm one of those, I get paid first, sorry. I'm not, I like it. So once we have all of that information, the clock starts for us. It's about 7 to 10 business days. We're in contact with you guys as we go through the process to let y'all know, hey, this is where we're at. We're sitting here, we should have this ready by this time, and then if we need to set up a conversation with you guys, we do that as well, just to review results if necessary. But yeah, so, and then if there's questions or something like that we have, obviously we're in contact with y'all through the process as well. So.
All right. So with that, everybody, we're going to wrap this up. Thanks, Brittany, for sitting in again. Always a pleasure to have you on board, and thank you so much.
Thank you, Doug. I appreciate it.
All right. And we'll let everybody go. See you next Monday. More news coming.